Okay, so we're going to get started, even though we're just at 10:31, but we'll get started anyway. And if we get anyone else, they can just join in. So the purpose of today's workshop or presentation is about bookkeeping, so accountancy and bookkeeping in your business. And my name is Lisa Moynagh, and I run a small practice called Bright Vision Accountancy, just outside Armagh. So I've had the practice for 3 years. So I was once a new business also, and grappling with all the different areas, maybe not the finance side, but the other sides of it that I didn't know either. So previously, I've been a chartered accountant for 12 years. I worked in Belfast for the majority of that, some of that in KPMG and some in businesses then doing finance, like in finance departments. And then I set up Bright Vision Accountancy, as I said, 3 years ago. And my reason for setting up the business is similar to why a lot of you have probably set up your business, and that's in and around, you know, having some time freedom and also having it the way I like it. So I get to work with the clients the way I want to now and spend a lot of time with people. So it's very good. The purpose of today's workshop is really to talk about the financial considerations around having a business, and you know what the responsibility side of it is, and then also how the numbers can help you run your business and what the benefits of that can be. It's not everyone knows that there is a benefit in it, but really there is. And I would just encourage anyone who has a question to put it in the chat box, and I'll keep an eye on the chat box as we go along, just to make sure that we're answering everything that you need. Every business that comes here today is at a different stage. Some people have maybe not even traded, some people are trading a year, some people are trading 5 years. So what I'm talking about might not be relevant all of the time. So it's going to be important for you to kind of feedback if there is anything in specific that you want. I'm going to bring it right back to the start and talk about the different setups of businesses, because that kind of does affect the financial side of things. And then just when you're up and running, why, you know, what bookkeeping really is and what you can have to do, and then why numbers are important in your business. Talk a little bit about reconciliations and financial statements. Not going to go into it too much because, you know, it's not going to be relevant for everybody. But then we'll also look at cash flow, which is a massive thing in small businesses and all businesses. So we need to look at that and try and get some rationale around the difference between profit in a business and cash in a business. We're going to touch on the self-assessment tax return, because I know a lot of you are maybe newly self-employed or set up a business and have never completed a self-assessment tax return, especially if you're coming out of work. And then we'll cover off any questions at the end, but I will check for questions as we go along. So I want to move now. So the first thing we're going to look at is when you're setting up a new business. So the right time to set up a business. Really, that's an individual thing. Like I'm saying, every business is different. But if you were working and you were doing your business part-time on the side, when is it a business or when is it a hobby? You know, can be a confusing question. But when you look at it from the eyes of HMRC or from the government, if you're earning over £1,000, then they will consider that as trading. And that would be a time when I would say, look, you have a business and you need to set it up. You need to set up something around that kind of gives you a bit of structure on your finances. If you're setting up a business, the two main types of businesses set up is a sole trader or a limited company. There's some people can be a partnership, which is basically sole traders together. So they're in a partnership. But the main distinctions is sole trader or limited company. And there's different legal requirements for both of them and tax reporting obligations for both of them. Which we'll touch on a little bit, and not to go too into it. You probably covered it if you've done anything like the Go For It program, but it's a big distinction when it comes to paying yourself or managing the finances of your business. Then the other thing that you're going to think about when you're setting up your business is how to finance it. So if you have to buy stock at the start, or if you have an investment piece to do, are you going to put in money that you have of yourself, or are you going to get a loan or other borrowings? And the main thing that I will highlight for any kind of business is if you are trading and you're keeping a business, make sure you get a separate business bank account. Have a business bank account set up for your business, totally separate to what you're doing personally. That will make managing the finances much, much easier. In fact, it will make everything easier. And it's sort of, once you have a limited company, you'll have to do that. But if you were a sole trader, it's easy to fall into that way of mashing it all together, but then you kind of never know what's your business and what you're actually taking out personally. So that's one of the main things. This slide makes it look like being a limited company is amazing. It's really not. It just gives more options. So for a lot of people, being a sole trader will be still brilliant. You can be your own boss. You don't really have to set it up. In a way, you can just start to trade in the morning. You can work with a variety of clients. With a limited company, you have to incorporate a company. You know, you have a choice of how you pay yourself. You also pay corporation tax and you have limited liability. So I'm going to go into each one of them just a little bit more. So if you're a sole trader, how you're viewed by the government, or well, by HMRC really, because that's who we care about when it comes to tax and finances, is that you and the business are one unit. So the business is you personally. There's one tax number that kind of sits over you, and you file your self-assessment tax return every year, and it covers the trade that you're making on your business. And you have to file it by the 31st of January after the 5th of April. So the tax year runs, it's so confusing, the 6th of April to the 5th of April. And then once that 5th of April passes, you have until the following January to file your tax return, okay? If you have started to trade in a tax year, you have until the October after this 5th of April to tell HMRC, I need to do a tax return. And it is up to you to let them know that you should be doing a self-assessment tax return. If you're trading and you hadn't told HMRC, I need to do a tax return, they find out, then there can be penalties and interest and things. So there's a form on the website. I'm going to cover self-assessment further down, but there is a form on the website to let HMRC know, look, I'm self-employed now, or I have a business as well, and I need to complete a self-assessment tax return. And you can decide when your books and records will start. You don't always have to use the tax year for your finances, but I would recommend that you do, because when you don't, there's like this little, like, they kind of estimate how much it would be to bring it to the 5th of April all the time. If you picked, say, the 31st of December, they would estimate the rest. And sometimes you can pay a little bit more tax at the start of your business starting, but you would get it back when the business ceases, but like that could be 20 years away. So, I mean, I would recommend that you just work with the tax year as much as you can. When you choose a business name as a sole trader, you can choose any name you want. You can choose your own name, and you can choose something that makes you stand out. You can actually use a name somebody else has. But if you do use a name somebody else has, there's no legal requirement going to stop you doing that if you're a sole trader, but it's confusing for your customer. So I think maybe that's something where you might want to make sure that you're picking something that's relevant and going to help you stand out and help people find you and what you're about. And we'll go further into the self-assessment side of things further down, but if anyone has any questions on whether they are a sole trader or a limited company, some people don't know, you can let me know. Just on a limited company then, if you set up a limited company, what you're doing is setting up a separate legal entity, it's called. So you're setting up a completely separate, if you think of it as in like person. So in the eyes of HMRC, there's you, and then there's a limited company. The limited company has reporting obligations. It has to do a corporation tax return, and it is doing the trading. It is the one that is creating all of the money and the profit, and you are the director or the shareholder of that company, and you have to take the money out. So this is kind of where it can get a little bit confusing for people who set up a limited company. There's extra requirements, so they have to do a corporation tax return, and they have to file a set of accounts every year. Plus, the person who's the shareholder will also have to file a separate tax return. So that can be a little bit more. Most likely, it says may also, but they most likely will. You've got 9 months after you can decide your company year end. So if you set it up now in May, it's likely your year end will be the end of May, and you've got 9 months after that then to file your accounts and your tax return, which usually works fine. The key distinction about a limited company and a sole trader is when you want to take money out of a limited company, the profits and the cash in a limited company belong to the limited company. So there's methods of extracting, and that's one of the big advantages of a limited company, in that you can take a mixture of income. You can take salary and you can take dividend. When you're a sole trader, you can only take drawings, it's called, and you're always going to be taxed at income tax rates. But if you're a director of a limited or shareholder of a limited company, you can take dividends and a salary, and dividends are taxed at a lower tax rate. So it's more of the decision really on whether it's worth it, because there obviously is a bit more red tape, is the size of your business. If your business is at a certain size, there's tax advantages of being in a limited company. There's also another big advantage of limited liability. So like I said at the beginning, if you were setting up your business and you needed to get a loan or some kind of investment, if you got that and it was within a limited company and the business was not successful, there would be no implications for you personally because the business is seen as separate to you. Whereas if you were a sole trader and you got that loan and the business was not successful, then you may have a personal liability and you may have to give up a personal asset to settle that liability. So that's a big advantage for maybe a business that has a risk around it or anything like that. Another key distinction is that a limited company's business name cannot be the same as any other registered company name. And if it's too similar, the Companies House won't really like it, they won't let you go through with it. It'll have limited or limited at the end. And if you go online, if you are thinking maybe a limited company is the right vehicle for your business, there's a name checker on Companies House and you can search for the names that you want. And if there's another similar business, it will bring it up. And if not, it'll let you know you'll be fine. Incorporating a company is simple. You can do it online on Companies House. You can get somebody to help you to do it, but it's not like as difficult as it maybe would have been years ago. They're very, very common. They're used a lot. The key is just understanding the distinction around when the money is made. You can't just decide to pull it out as you wish. You have to have it thought through, whether you're going to take salary or dividends, and make sure there's dividends there to take. Okay, so I'm not going too into it because it is probably a little bit, not that, it'll be a bit overwhelming maybe, but other key considerations is if you're going to be an employer. So if you have even one member of staff, you're an employer. If you have someone who's working casually with you and they're working regular, you can be seen as an employer and you would have responsibilities there in terms of registering for a payroll service and take employee deductions. So what HMRC do is they get basically the employers to collect the taxes from most of the country. So as employees, we are going to our employer and the employer is paying us and deducting the tax and paying it to HMRC. And that is a role that if you are seen to have a staff member that you need to sign up for and complete. If you've got any benefits in kind, so if you do have employees and you are paying for expenses, if they're not business related expenses, they might be benefits in kind. If you've got cars and things like that, or paying for fuel, mobile phones are exempt. There's a whole list of what's exempt and what's not. Again, not going to go into too much, but it is an area that if you have questions around it, get some help and get it going. Every employer must also provide a pension, so they have to offer it. You have to offer it, and if your employee wants it, then you have to set it up. But if the employee, it doesn't want it, you don't have any employees, you can opt out. So you just need to register that with the pensions regulator if that's relevant. The next thing that you're going to want to consider is how you're going to monitor and track your business performance. So this is where the books and records come in. Yes, you have to do bookkeeping because you have to do a tax return and because you need to know how much tax to pay. But you also want to do books and records because it's going to help you to see how your business is performing. You can monitor payments from customers. Are they paying you? Who do you need to pay? And you can make sure you're making money, that your pricing is correct, that you're making margin. And we'll have a look at some of the reports that can show you, am I making enough money at the top level, at the product level alone? I'm going to go through a little bit about that. And then we'll also look at cash flow. So if you're keeping your books and records, you're looking at what's going to come in your cash, what's going to go out of your cash over the next few weeks. And do you need to manage that? Do you need to get an overdraft, or are you going to have surplus cash? Is there something else you should be doing with that? So they're the key considerations that having your numbers right will help you with. Another thing that's coming up now is making tax digital. So we already have this for VAT, and VAT, you have to have a software package or you have to have some digital records for your VAT return now to submit it to HMRC. And making tax digital for income tax, so the self-assessment side of things, is actually coming in next year in 2023. That's going to shake up everything. It's going to shake up a lot of how tax is completed, how self-assessment tax returns are completed, because they're going to expect digital records that link back to something like a bank statement. And this is the rise of all of these accountancy packages now. They're going to become a must for anyone who has a sizable income, who's trading as a sole trader especially. And the other thing is making tax digital will eventually come to getting people to submit their tax return more often. So instead of doing it once a year, the government may eventually down the line ask people to do it quarterly. And that is one of the areas why we are encouraging as many people as possible to look at a digital option for keeping their books and records, because it's just going to make things a lot easier. So using software and other resources that are available to capture your transactions in your business will actually give you a benefit down the line when things do change. So I've added in a few of these little mindsets to give people who are starting on a business just a little bit of an understanding as to how the mind can work on this. Well, I'm not a mindset expert, but I have started my own business. And I know that when you start off, you have this what you think should happen line. And then you're starting new habits with your business. So you're waking up every day, and the actions you need to do to progress your business, they're different maybe than what you had to do before. So you're forming new habits, you're forming changes. So you sort of fall down over time. You're coming up a little bit slower to get to where you think you should be, as you're establishing those new habits. And that will be in and around your bookkeeping, in and around, you know, responding to customers and dealing with suppliers and all of the things that's going on. There is a level of time when it will take for you to get to where you want to be, and it doesn't always align with how you think it should go. So it's called the plateau of latent potential. And it's just to say that even if you are feeling like you're started your business and you're kind of not where you think you should be, you know, if you know you're doing the right thing, you know that the actions you're taking are the right ones, then over time you'll get back where you want to be and get a little bit higher. And then the other thing that I've also added here, which I think is a good estimate for anyone who's growing their business, if you're growing your business, you'll be, obviously the expectation is usually always a little bit rosier than we get, but you're coming up and you're growing your business, and then all of a sudden you feel like you hit a point here where you just cannot get past it. This ceiling of, it's called a ceiling of complexity, but that ceiling is probably the point where you need resource or you need help with something. So it could be a cash flow issue, for example, and maybe you adopt a new system and you change your supplier terms, your customer terms, and you kind of break through that and you get up to the next level. And then the next ceiling might be that you need a new member of staff, or you need to look at what roles you're doing versus what you can outsource. So this is just kind of some considerations of when you set up a new business, to be mindful that, you know, there will be points of it that are, you hit a frustrating point. And in most of these points, numbers can help, because if you're here and cash flow is tight, go back up, you can use your numbers can help you identify what's going on. If you're here and cash flow is tight, or you're here and something's not right and you're thinking, you know, my business is starting to dip again, you know, maybe you do need more resource, but can you afford that new person? You know, you can always relate everything back to a number in a business. So I'm just going to check. No, good. Okay, so now we're going to get into the few numbers, and we're going to say now, why do we need numbers? So as I said, we need them from a compliance point of view, but really we need them for information. We need them so we know what's happening, and every business is different. So there's not two businesses who use figures the same, and it's important to understand how your business operates. You know, what is your product? What is it made up of? And what does it cost you to produce that product? And then what are your additional costs around that? So your rent, your rates, your overheads, and the mix for every business will be slightly different, and the more essential areas will be different for every business. So numbers are important because they tell the story of your business. They'll show you symptoms versus root cause. So some symptoms might be cash is getting short. The root cause may be customers are not paying you in time, you need to change your payment terms, or you're paying suppliers too fast, you need to negotiate some payment terms. It'll help you with some early warning signs when there is issues in your business, and they'll show you areas of strength and areas of weakness. They'll give you a chance to do better decision making, and as we always say, knowledge is power in your business. So, what records should you keep? You need to keep anything that's really a business-related income or a business-related expense. So if you're raising invoices to your customers, you need to keep a copy of the invoices, and digital copies are absolutely fine. And there's lots of different apps and software that will capture those on the go. Expenses then, so here we're talking about wholly and exclusively for the purposes of trade. So when you claim an expense, it needs to be, the term that's used is wholly and exclusively. So this is really something that if you didn't incur it, you wouldn't be able to produce your product or service. That's something that's a deductible expense, and something that you want to be claiming for. You need to keep purchase receipts. A digital copy again is fine, and you need to keep all of these things for 5 years. from the year you've traded. So you need to have some record. If HMRC wanted to query your numbers, or you wanted to look back, they would want them for they could want them for 5 years. There's two different types of accounting. So there's this traditional accounts, which is where you use the date of your invoice to work out how much you owe, and your profit and your expenses. Sorry, I'm not talking about. But the other area that this kind of affects more than anything is VAT. So you can use the date in the invoice to capture the VAT, or on the cash accounting side, you can do whenever the customer actually pays you, you account for the VAT, and when you pay the supplier. So the invoice doesn't become as relevant. Now, I don't know if anyone would ever need to go into this. If you were going to change, or you weren't sure about VAT treatment, I would recommend that you speak to an accountant, because it's never straightforward. And it's always good to make sure that, you know, if you think you've hit the VAT threshold, which is 85,000 in sales, so not in profit, but in sales, so turnover, if it's 85,000, then you have to become VAT registered. You don't have a choice. Some businesses will choose to become VAT registered, and that's a bigger decision. It's a more commercial decision. And if you are thinking of that and you're going to start preparing VAT returns, I would recommend you speak to an accountant, just to kind of analyse what type of income you have and what kind of expenditure you have, and make sure you're claiming for the VAT correctly. I'm going to have a quick look at Xero. So I will show an accounts package further in, and I'm really doing that to sort of show you the kind of areas that an accounts package can offer you to look at, and it'll also have highlight some elements of the business reports, what they mean, and the VAT, how it's accounted for. If you have a software package, obviously your VAT is accounted for in it, and you sign up for Making Tax Digital through it, and then you file your tax return. So if you are going to be reporting on VAT, or your turnover is going to be anywhere near 85,000, I would recommend that you get an accountancy package, definitely. So when it comes to doing your bookkeeping and keeping receipts and keeping invoices, you know, get some habits. So have your set that you do it like every second, if you're small, every second week, you know, every last Friday if you're very small, you know, maybe Friday every 2 weeks if you're a medium size. And if you're very big, you need to be having some bookkeeping processes in your way of working at least weekly, and sometimes most businesses are daily once they're big. And don't wait, you know, especially if you're a sole trader, it's very, very easy to wait, feel like it's small and manageable, and then the tax year passes and you kind of don't really have you can't make any changes. So once the tax year's passed, you're stuck with whatever way it was. So if there was a more tax efficient way of doing things, or if you were doing something that wasn't right, then you have a whole year there to fix. The other thing is, if you are operating in a way, so for example, the cost of your raw material started to get higher and you didn't notice it because you weren't sort of keeping track of your figures, you could have been through the year and maybe end up losing margin before the end of the year. So it is important to keep recording it as you go along and try and then get that overview picture. And apps, you know, there's lots of apps. There's auto entry and Dext, which help, you know, capture receipts and invoices. And then obviously the accountancy package like Xero and QuickBooks and that, which I'm going to cover on as we go on down. So this is just kind of the bookkeeping process and why you kind of use it. It's a wee bit more, this middle bit's a bit of an accountancy spiel, but really the key is the source documents and the invoices. So it's like garbage in, garbage out. The key is how you record your transactions. They seem trivial, but once they are recorded correctly, they feed right into the financial statements, which is like your profit and loss, which is one of the key documents that will help you keep track of your business. You know, are you making money? And that's kind of one of the areas that, you know, would encourage people to establish a process around these source documents and invoices, and just ensure you're capturing correctly those transactions that make up your business, and then they feed into your financial statements. So we have Xero, Sage, and QuickBooks. I've just put these ones up. Personally, myself, in my own practice, we use Xero, but they're all good. They're all the same, really, as long as you kind of get to know it pretty well. They'll all do the same thing. And then this is a little bit more accountancy spiel, but it's just to kind of give you a little bit of background into how it all feeds into the accounts. And again, it will come to you over time anyway. You'll learn this anyway, but basically bookkeeping is a method of recording transactions in a business. And so sales and purchases and bank entries that are maybe not sales and purchases. So like, for example, a bank fee, they're recorded in what we call accounts. And that's just like really like a record. So you'll have like a sales account and you'll have like a bank charges account. And they're just, you're really just classifying. You're going through your bank account or going through your transactions for your business and classifying what they relate to. And all them different accounts that you say they relate to. So you might have raw materials and you might have insurance and bank charges and rent and sales and carriage or delivery, right? Every business will have a different set of those accounts, and that's called a chart of accounts. And the chart of accounts, there's like a standard set, and then there's always those one or two extra types of account that each business needs. And I would recommend that you think that through when you're recording your expenses, because next year you might want to compare back to that type of an expense. So you don't want too much detail, you just want the ones that are relevant for your business. And then at the end of that period, you get like what's called a trial balance. It's really just the total of all of those accounts. And that's what gives you your financial statements. That gives you a profit and loss and a balance sheet. There's certain terms that you see when you're looking at a profit and loss and a balance sheet. I've just included them in here as key definitions. So again, if you get an accountancy package and you run one of these reports, you will see these account codes, these kind of categories. And it's just kind of to identify that if something is an asset, it is something that you own or your company owns, and it has value. So it could be money, it could be goods as in stock, or it could be, well, it wouldn't really be services. I think that's, well, it could be an intangible service or something that you've banked up, but the likelihood is your assets are fixed assets. So equipment in your business and stock and cash, they're the main things, or people that owe you money. Liabilities are then things that you owe. So assets are what you own and liabilities are what you owe. And they're really all of the things that you owe people. So if you have an overdraft or you have a bank loan, the people you owe money to, they're your creditors. Your revenue and income is what's earned from doing your business. It's actually what people are paying you for your good or your service. And the cost of sale is costs that are directly related to providing that good. And the reason it's relevant to decide what type of cost it is. So if I said that I was preparing picture frames, one of my cost of sales is going to be wood to make the picture frame, glass for the front of the frame. They're the cost of sales. They are directly related to that product. And if I was to produce no picture frames, I would have no cost of sale. That's the idea, because what that will do is it makes sure that your pricing is right. It makes sure that the cost you're incurring to produce that product or service is being covered by the price you're charging, and it gives you a cost called a gross profit or gross margin, these two alone. And then expenses is just what's paid to support the operation of the business, also known as overheads, rents, electricity, rates. Likely if I produce no picture frames, I'm going to have to pay my rent, probably going to pay some electricity, going to pay rates, you know, so they're going to happen anyway, and they kind of sit below, which we'll look at. Drawings is cash or assets taken out of the business for personal use, usually by a sole trader. Dividend then is distribution of company's earnings to shareholders. So this is like if the company makes a profit, if you're a shareholder, you can take a dividend. And then owner's equity, this is if you're a shareholder, the difference between the asset and liabilities. So what you own and what you owe is also known as like the net worth of your business. So for some businesses, it's good to look, if you have more assets than liabilities, so you own more than you owe, we would say you're in a positive position. So your business owns more than it owes. But again, it's only relevant if you're going to the bank looking for loans and things, or maybe looking investment, that those things really matter. Cash flow is the net amount of cash moving in and out of a business. So cash flow is what it says. It's cash flowing in and flowing out, and it's making sure that you can cover the ups and downs of cash flow, is cash flow management. And then profit is the financial benefit when revenue exceeds expenses. So it's totally different to cash, because the cash could have been spent, but you've still made a profit. And I'm going to do a bit of an example on cash versus profit. I'll just, I had it down at the cash flow side. So I'll whip through these ones pretty quick, and then I'll go into the cash versus profit slide, because I think that will actually mean quite a lot. The next thing is, once you kind of get your head around all of these accounts and you're deciding what everything relates to, then there's a thing called a reconciliation, and it's really the long and short of it is it's just a check against something else outside your business. So if you've been keeping a track of all your income and expenses, You might want to check that against your bank statement at the end of the year and make sure that the total you have matches the total on your bank statement. You could also check how much you think you owe a supplier to the supplier statement, how much you have in your credit card statements, just to that you've captured everything. But again, if you have an accountancy package, a lot of these reconciliations happen within it, and we'll show you a little bit about that as well. They'll also highlight if there's a problem with your bookkeeping. So if you've recorded something in the wrong place, or if you had an employee and maybe something was going missing, it can kind of highlight that, especially around petty cash and things. So this is the financial statements. I'm going to show these in Xero as well. So this is just like a profit and loss. It's just showing you here. You've got your sales, and then any returns is your gross sales. You've got your purchases plus delivery charges is the cost of sales. And then this is the gross profit. This is the figure I was saying is the 2,000. I don't know if you can see my cursor actually, is the 240,000. What it's doing is it's basically saying we're making a profit before we take into account any overhead costs. Our product is making money. And then we put in the rest of our expenses to get the operating profit. And then usually at the bottom we add interest. So it is used to monitor business performance. I am going to show it in Xero how you might use it in your own business. But those statements are quite accountancy looking. The three key things just to be aware of is gross profit, like I said, which is the revenue less cost of goods sold. Your net operating income, which is your gross profit, which is basically this, less your operating expenses. So that's just basically what it's costing you to actually operate the business. And then the net income, that's where interest comes in, and anything else, like if you were getting the self-employed income support scheme or the coronavirus job retention scheme, they would come in as non-operating items, or like grant funding. And a lot of the time people would work out a percentage, say, well, I would expect, my gross profit to be 20% of my sales. And then they can keep track of that. If gross profit started to slip below that and started to become 15% of sales, you might think, well, look, something's wrong and I need to track that a little bit better. I need to go in and have a look at my cost of goods, what's going on. So again, this is a balance sheet. A balance sheet is what you own and what you owe. It has your assets at the top, so fixed assets, ones that don't move. Current assets are ones that do move usually each month, so they could change. What people owe you can change. Your stock will move in and out, your cash will move in and out, and that gives you a business total assets, and what the total the business owns, the worth of the business. And then the creditors are what the business owes. So again, falling due within 1 year, these are trade creditors will change. Accruals are costs that we want to take account of that we're obligated to pay, but we haven't maybe paid it yet. So for example, say your accountancy fee, you're going to have to pay your accountant at the end of the year, so you'll accrue it in because you haven't got the invoice yet. And then short-term loans, that can also be overdrafts. And then long-term loans come in as creditors after 1 year. I wouldn't get too caught up in understanding all the ins and outs of these reports at all. All I would say is put things in the right headings. And when you look at it, you want to have a positive net asset position if possible. If you find that what you owe is higher than what you own, it can lead to issues down the cash flow side of things if the business, as the business is growing. But it does happen in new businesses, so it's nothing to be deterred about. It's one of those things that it's all part of growing a business. Sometimes you do have to hit that bad position, and then the business will build up itself. So cash flow, this is the one I really wanted to go into, because I think this is the area that's of most relevance. So cash flow is the movement of money in and out of the business. So profit and cash are two very different things. And I'm going to just show you a different set of slides now that I have here. And that's going to hopefully illustrate a little bit better the difference between profit and cash. So it's very common for business owners to be frustrated that the bank account doesn't reflect profits, and it is really important to understand the difference between profit and cash, and why having a high profit doesn't actually mean you'll have more cash in the bank. So they say that turnover is vanity, so people just want high sales. Profit is sanity. Oh, we're making money, that's okay. But cash flow is reality, because you can have a profit in your accounts, believe it or not, and have no money in the bank. So it's one of those distinctions. And a profitable business can go out of business because it's starved of cash. and a business running at a loss can survive because it has cash. So we maybe have an investor, or you have a negotiated terms with your bank. So it really is the reality of what you're living is how you're managing your cash. So we're going to look at this slide in different terms and have a think whether they're profit related or cash related. So VAT is an area that only affects cash. Loan repayments only affect cash, not your profit. Interest on your loans will only affect your cash. Oh, sorry, will affect your profit. The interest on your loan will affect the profit. So it affects both. It'll affect cash and your profit. Asset purchases will only affect cash. Asset sales will also only affect cash. And then depreciation, it actually only affects your profit. So, you know, you can see that there's a lot of things that will deplete cash. And then they don't show up in your profit. So you're still, you know, making money on this left-hand side, but on the right-hand side, you're spending money on asset purchases, you're paying back loans, you're paying VAT, and all of those things can kind of change. So just going to have a quick look at this, the 101 cycle. It's just a way of showing profit and cash as well. So first of all, you are the owner and you're going to invest in your business. And then this money is used to purchase assets, and that just generates business income. So and then you might need more funding. So you're going to get some new loan finance here as well, just up at the top left. You can see that coming in. And then once you do that, these assets all generate a profit. So this is the return on your assets. And then you can increase your profit by growing your sales or improving your margin. What we mean by that is by reducing your cost and keeping your sales or increasing your selling price. And it just gives you more and more profit and more and more. But then the thing is, overheads will start to drain that. So if your overheads are starting to rise, they're what we call profit drains, and they're like maybe taken out of your profit at the end, or your net profit. So you can sort of, you need to sort of have a look and see. So then the next thing is the profit then gets turned into cash. So you've got drains in your cash, which is your debtors not paying you on time. You've got high stock, you know, loan repayments, tax repayments, and payments to suppliers. But then you can get benefits in your cash by collecting your debtors on time, improving your stock control and your stock days, putting some longer payment terms in with suppliers, and then reducing your tax payable. And tax efficiencies is one of the main things if you're running a business, and making sure that you are claiming for everything you can claim. And equally, if you're running a limited company, that you're extracting your profit in the most efficient way. And so the aim for a business is to go through this. So then this is if you're then the owner, you're going to take out of the business withdrawings, and you're going to also maybe have some personal loan repayments, and they deplete the cash value as well. But really the idea is that you want to spin this circle as fast as possible and as efficiently as possible to get more money that you can kind of take back out of the business. So I've just put them in because I think that they kind of illustrate a little bit better that cash and profit are not the same thing. And then this is just another wee bit on the key drivers of business. So every business will be different. That's what I'm saying. And some businesses will have like a monthly recurring revenue. Some will be really hung up on revenue growth. Some will matter revenue per client. Sales can be the biggest one for some, and profit could actually be a bigger one for some. So I just put them in because I thought it would help illustrate the cash flow differences between cash and profit. So then when you're running out of cash, it will threaten the survival of your business. So I've said here every business should have a cash flow forecast, really not a big formal report that has, you know, that you don't understand, something that helps you understand, this is how much I have in the bank, this is how much I'm going to have to pay next month or over the next 3 months, and this is how much I expect to come in over the next 3 months. And that's really a basic understanding of, will I be in a position that I need help on cash, and then how can I get it? It's totally fine if you need help on it. You just need to make sure that you have the help when you need it. So you speak to the bank, or you have an investor, or if you're willing to put the money in yourself. It just, you know, it just helps you to plan it. And then one of the key areas on cash flow is when customers are paying you and when you're paying your suppliers. And it's probably the main thing that can be changed easily by a business owner. So they can say to their customers, if I want paid up front, or I want paid on the day. If it's a service especially that's being performed, or goods that are shipping, you can ask for payment before they're given. For suppliers then, bigger suppliers will nearly always give you some payment terms, and you take advantage of those if you need them. Formalize and implement a proper credit policy. So this is where you're checking the customers you're using. If they're not a repeat customer, maybe just have a check that they're reliable before you allow them to have your goods or service with and pay for them in 30 or 60 days. So stock management then, another thing is to make sure that you are looking after your stock. If you work in like a food business, you want to make sure that you're not having stock that's perishable and that's going out of date. Or if you have something like in a technology business, like stock can go obsolete very quickly, things do change. You just kind of want to always be managing your stock well. And rationalizing costs, that just means going through all of the different costs that you incur and have a think about, right, what do I need to do to improve this? This is just how a business can grow, and I'm just showing it to show that there's 5 different areas that you might want to be looking at if you're growing your business, all of which will derive from numbers, and you'll have those if you have an accountancy package. One is to increase your sales. One is to increase your gross margin, which is the difference between what it costs you to produce the product and what you sell it for. One is to increase your profit, so that's the total all that you get after you work out what it costs you to produce the product plus all the rest of your expenses. You want to be increasing your cash flow and optimizing your assets. So if you have assets, making them work for you in the best way. It's just a way of thinking about how you're at your current performance. If you concentrate on each of these different areas to grow your business, then you will get business growth. I'm just going to go in and show Xero here. So I did say I would show it because I thought that it would be useful if anyone is thinking of having an accountancy package and maybe wanting to have an accountancy package and they don't know what it looks like, and it'll sort of help me explain how some of the bookkeeping can happen as well. So this is just the demo company in Xero. This is just what's called the dashboard, and the main area in Xero is this business bank account. So no matter what bank you're with, it will integrate with Xero and your bank, or with whatever accounts package you pick, and the bank lines come through automatically. When they come through, the main work is reconciling these accounts, reconciling what's in your bank and matching it off. So there's a couple of different things that you can have a look at first of all before we go in there. Invoices is what you're going to raise to your customer, and bills to pay are what customers pay to you. So when you raise an invoice, this is just an example of all the different invoices that can be raised. You can go in and raise it in Xero or wherever you're doing it. If you're doing it on paper, the idea would be that you would keep an invoice. If people are buying from you on the web, so they're buying from you and paying via PayPal, not everyone would keep an invoice. All they would do is go in to the business bank account, and this is where all of the transactions are coming through. And for example, PayPal might be one of these coming in. Now you could go in and just hit OK or code this to sales, for example, if it's money in. Say we said this was PayPal, and you code it to sales and you put in the customer name. Okay, so you could do that, okay? But the problem is if you're doing sales from PayPal, they're taking a fee, and the amount in your bank account is actually showing a fee. So your gross sales before the fee is a different amount. So depending on your type of income, you may need a little bit of support in how to make sure you're recording the total sales for your business and getting those things in. If you have a bill to pay, then you can add a new bill here. So you can go in and put on the details of the purchase invoice, or you can use apps for both of these that will bring the bill into Xero for you. And that's what I would recommend people do. Now, it's a little bit more of a separate session, and it's more around using an accountancy package. But when you do, a soft copy of each receipt will be kept in Xero or in your accountancy package, and then you're sort of keeping all your records in one place. The invoices you raise and the bills that you owe are then being paid through your bank account. And it's through this then that you just kind of match them off. So here it recognizes that you received money from an invoice that had been raised, and you're matching it off. Again, you've paid money from an invoice that's been raised that you owe, and you're matching it off. There's reports called aged payables and aged receivables. And what they'll do is they'll help you see, right, who owes me money? So if I look at aged receivables, this is, sorry, the aged payables on this. If I look at the aged receivables, this is who owes me money, and I can go through this list and speak to these individual customers and chase the money in. And if you've seen something was getting very old, then you could be thinking, well, I'm not going to sell to them again. And the other area that you want to be keeping a track of is aged payables. So you're thinking, right, who do I owe money to? You know, right, well, look, you know, I need to start paying some of these people, or, you know, is this amount correct? And it's just a way of keeping track of your figures, whereas if everything is in separate bits of paper, it can be nearly next to impossible. Xero, like all packages, will have reports. And the two main reports, is the two I mentioned earlier when we were talking about it, was the balance sheet and the profit and loss. So this is a typical profit and loss. You've got your sales, and in here is all of the invoices that you've raised, and we want it to be gross sales. So sales before the fee from PayPal, before the fee from Ticketail, whatever you're using. That's the sales, and then the fee should come in after as a cost of sale, pretty much. Then you've got your cost of sales, and that in this case it's just purchases, but you can have as many codes here as you need. And this is the gross profit. This is the figure that you would be keeping a track of and saying, right, well, look, I just want to make sure I'm keeping everything correct. You can view this by month or by year, and it will then let you look, you know, year on year or month on month. Well, look, I know my advertising should be 2,000 each month. If some month it's 4,000, well, there's something wrong. Or maybe, you know, something you weren't aware of going on. Again, keeping track of all your business expenses, and then you've got your operating profit. Your tax charge will come in if it was relevant, if it was a company, and then your profit after tax if you're a company. So it's really whistle stop, just have a look. I don't want to bombard anyone, but it was more to show that these reports are useful in running your business. And you know, the area we're going to look at when we touch on self-assessment is that, you know, keeping your track of your assets in your business is worthwhile, because even though they don't go into the profit and loss account, they do offer tax advantages via capital allowances. So it is it's an important number. It also builds up the worth of your business. So if you're looking at the assets in your business, the more assets you have, if you wanted to sell your business down the line, and just, you know, it just improves the balance sheet position. This is what people say is the worth of the company, because it's obviously what you own and what you owe. And then just, yeah, so really that's all we'd use these for. And then obviously the VAT, if you're going to use a package for your VAT return. This probably isn't linked with anything, but it'll come to this. Obviously it's a demo company, so it just links. You can go without making tax digital, but now everybody has to be making tax digital for VAT. So you would just set it up, and it would link directly with HMRC, with your government gateway and HMRC, and you'd be able to file your return through the software, and the lines are then marked off as having been used in a VAT return, and they won't get put in again. So if you're going to be VAT registered, I highly recommend getting Xero or Sage or QuickBooks. And, you know, if you need any help with that, or if anyone has any questions on that after, and they want to maybe have a bit of a one-to-one, it is quite a bespoke thing, then, you know, we can have a look at that. So we had a look at that. Yeah, so yes, we had a look at there. I'm just going to go back to where. Yeah, so then this is just wanted to highlight about the reconciliations, where I was saying about the bank reconciliation in Xero. That's the main check that we would ask people to keep an eye on in their businesses, because if you're making sure you're capturing all of the items that's in your business bank account, because it's obviously set up for your business, if they're being allocated and coded correctly, then the financial statements that you're producing and relying on and making decisions on will be accurate, rather than coding things and maybe not being sure and then finding out actually this isn't working out. So just, I know everyone has probably done a business plan with Silo or whoever, and I know people have probably looked at preparing a cash flow forecast and some projections all around numbers and stuff. And now we're talking about how you need to keep your receipts together, how you need to record them in something like a software package, and keep track of the reports then to keep an idea on how your business is performing. But this is just a little slide that talks a little bit about how maybe you need to look into a wider view of your business, and how, if you're getting all these reports, so you're bothering to do all of this and you've got these reports, and You can see how your business is performing. It's quite important to think of where your business is going in 5 to 10 years, and also where you want to go. So you want that everyone's in business because they want something out of it themselves, and let that be to sell it, or business security, or to pass it on, or to merge, or whatever it is you want. And it's about having that vision of that, and then bringing that back into, you know, right, well, what does the business need to provide in 5 to 10 years, and what really does that look like for 12 months? And it is around numbers, but it's very much around vision, and what you want, very much around like breaking it down, then taking your 12 months, bringing it into 90-day goals, so 30 days, so taking your profit and loss account, taking a financial report. I'm going to swing it to finance here, but it totally could be on number of customers, or how many people you're helping, or the impact you're having with your business. You know, it can be other measurements, but it's about bringing back that bigger picture to 5 to 10 years, to 12 months, to what you need to do in 90 days, and then obviously what you need to be doing every day. And then it means those ongoing tasks that you're doing, let that be your bookkeeping, or let that be dealing with, you know, different staff members, or how you're approaching customers and things, is kind of aligned with the bigger picture. So the finances kind of coming around that, and the numbers you might want to track. Yeah, so KPIs, key performance indicators, will depend on what you want from your business. Like, some people will not want a massive profit or sales business, and you know, it's maybe just about being as profitable or as tax efficient as they are. So the bigger picture is very important, whenever you're looking at all of your business operations, and finance is one of those areas that's not going to, you know, it's not going to walk out and get new customers, because it's not the product or service, but it's one of those, like marketing, it's a thread under your business, and it kind of has to align with everything else that you want in it. So I'm just keep checking the chat box in case there's any questions, but it's very quiet. I've put in a little bit about self-assessment tax returns, sort of under the assumption that most people have started a new business and maybe will be obliged to fill in a tax return for the first time. And even if you are a sole trader, or you have a limited company, there is a chance that you will have to complete a self-assessment tax return, because tax returns must be completed by anyone who's a sole trader, anyone who's in partnership, anyone who is a director who receives funds other than payroll, which is very likely, if you have a limited company, that it'd be worth your while to be getting funds other than through payroll, so obviously through dividend. Also, anyone who has additional income that's not taxed. So if you have an investment property, or you get rental income, or other company dividends, maybe that you're not actually working in, then you are obliged to complete a self-assessment tax return. If you sell an asset like your home, or another investment property, or something that's a chargeable asset, obviously there's many assets that are not chargeable, but anything that are, and you likely will know about it, because if you sell an asset that's chargeable, there is requirements to fill in the paperwork at the time, and HMRC will know, oh, this person has made a capital gain. And then also if you have any foreign income. So I just put that in sometimes for people who work maybe in the Republic of Ireland. I get a lot of clients like that. I'm quite close to the border, and if you're working in the Republic of Ireland, or doing any work or across borders to the Republic of Ireland or Europe or America, then that's considered a foreign income, and we do, because you're a UK tax resident, you would be expected to declare that on a self-assessment tax return. The returns are based on profit and income made in the tax year, the 6th of April to the 5th of April. The only time that is different is if you're a sole trader and you've said my year end is the end of December or whatever date, and you decide to make your books and records up to that date. But as I said, HMRC will then assume the next 3 months. They prorate it so that it only ever includes 12 months, but they will make adjustments to estimate a covering until the 5th of April. If you have to register for self-assessment, you just click on this link, which I'm going to click on to show people. You're basically registering why. So are you self-employed, you're not self-employed, or you're registering a partnership? And you have to follow the link that's correct for your situation. Sorry, I'm going to have to start again now. You select the option that's applicable to your circumstances, and then once you fill in all of your details, HMRC will send you what's called a unique taxpayer reference number. And anyone who has to complete a tax return gets this UTR. So if you have a company, it will get a separate UTR and you will have a personal UTR. And it's really just a tag that HMRC knows, right, we expect to get a tax return from this number. You can create an online account, which is a government gateway, and you use your UTR for that. And that's how you can submit your self-assessment tax return. This is assuming that you're going to do it yourself. If you have a small business and you're comfortable with figures, doing your own self-assessment is absolutely fine. If you have a limited company or your business is sizable and you're really not sure, I would advise that you get some help registering and completing your self-assessment tax return. Once you're registered, these are, a lot of this is from HMRC. So once you're registered, your responsibility is to keep accurate records. So we've been going on with that for ages, but what I'm saying here is this is why you want to make that gathering of that information as easy as possible, as habitual as possible, because it is such an important part when you come through to doing your tax return and when you come through to looking at your business. It's those habits that kind of stand to you, because it makes it a lot less work. If you wait to the end of the tax year or you wait till your business is in trouble and then start having to go through it all, it can be very, very time consuming, and it's counterproductive really. So you need to do it by the 31st of January every year. Like I said, this is assuming you'll do it online. You can post a paper return. It has to be in by 31st of October after that April deadline. Most people don't use it. And it covers the profits and income you've made in that prior tax year. If you owe HMRC more than £1,000, so they will work out your profits and tax. So it'll be very similar to your profit and loss account. You take your sales, your expenses that are allowable, which we're going to look at a little bit again, that are allowable, that gives you your profit at the bottom. And then then they work out your tax on that. So there's different tax bands. Everyone gets a personal allowance. So the first 12,500 will be tax free. And then after that, you'll have to pay a tax on those amounts and national insurance. If the amount that you owe after those things have been applied, then if it's over £1,000, HMRC will ask you to pay that tax by January plus half of that amount again, which is called a payment on account. And then it's sort of like a way of you banking the tax for next year. And it can be a bit of a sting when you first start to have to pay them, because instead of having to pay them £1,000, you have to pay them £1,500. Whereas if you owe them £5,000, instead of paying £5,000, you have to pay £7,500. And the extra 2.5 goes towards your tax bill for the next tax year. So it's almost like a prepayment. And you pay again in the July. And then those 2 extra payments go towards that tax return that you're going to file in January. So it's sort of a way of them ensuring that they're not always waiting for the money. And they kind of know that business owners are earning the money as the year is going on. And it's very easy for it not to be available come January. If you're a sole trader, only if you're a sole trader, as well as income tax, you'll have to pay class 2 and class 4 national insurance. So class 2 is a set amount per week. And then your class 4 is 9% of your profits above 9,500. So your class 2, you'll only pay that if you're earning over 6,500. And then class 4, you pay over 9,500. So it just kind of depends on the size of your business. And then if your annual turnover is above the VAT threshold of 85,000, well, that should be 21, 22, but it hasn't changed. The VAT threshold hasn't changed for years. You need to register for VAT. And if you hit the 85, you didn't realise, this does happen some new businesses where they're maybe not keeping track of the books and records and they haven't kept a record of it. They've hit the 85 a few months ago. They have to go and backdate their VAT returns, and they have been selling their product to customers without charging VAT. They're going to have to account for the VAT themselves. So that's a cost and the business has to pay by itself. You get a penalty if you miss the deadline, or you miss paying your bill. And you get £100 if it's up to 3 months late. And you'll pay more if it's later, and if you pay your tax bill late, you'll also pay interest. So the penalty regime, it basically works on a 3-month cycle. So you get a penalty if it's late for 3 months, and then every 3 months they'll add an additional penalty, about 5% of the tax that's due. But you can, if you do submit the return and you want to make an amendment, you can make an amendment for up to 12 months. And if you miss the deadline and you want to make a change, you have to just write to HMRC and let them know. But, you know, hopefully most people's return would be quite straightforward. To prepare a tax return, you're going to use your bookkeeping records. So like I said, a profit and loss report from Xero, or if you've been keeping records through your bank account, maybe something in Excel. A lot of people do use that. You want to just verify it with your bank statement. If you have been keeping a record outside a software package and you're not sure if it's actually accurate, check it with your bank statement. And for your allowable expenses, you can only include business expenses. So anything that's wholly and exclusively for the purposes of trade has to be, you know, if there is a personal element, you need to make an adjustment for that. So for example, if you have a car in your business, your sole trader use your car for business, you need to make an assumption of how much is business and how much is personal, of your fuel cost, of your motor expenses. And the alternative other than doing that is you can just claim for business mileage, where you can take 45 pence per mile up to 10,000 miles and 25 pence thereafter of every mile that you have that's business related, but you need to keep a log of where your travel is and make sure at the end of the year you're putting all of that in. So there's another link here, just shows you like how to fill in your report. The supplementary pages, whenever you go in to fill in your tax return, it'll ask you a series of questions. Are you employed? Are you self-employed? Do you have property income? You know, do you have foreign income? And that will dictate what actually comes up when you're filling in your tax return. So there is all the different supplementary pages. You know, the actual form is designed for everybody, and you just fill in the pieces that's relevant to you. Allowable costs then, I kind of have touched on this, but I'm just going to follow through in case there's anything I've missed. So you may need to adjust for personal use, fuel and telephone. And then there's also some costs that are allowable. It's like charitable donations and pension. And even if you're, no matter if you're self-employed or not, if you have been contributing to a personal pension scheme or done some gift aid contributions, there's tax relief options for those. And when you fill in your tax return, you want to ask for those. That gives you more, what we say, basic rate, so a lower rate tax on that income, on income of that level as well. So if you've been putting in, say, 5,000 into your pension scheme, that's an extra 5,000. You can get a 20% tax. When you're working from home, you can apportion the cost and deduct them. The HMRC has some guideline calculations, but anything reasonable is allowable. So if you've been working at home for your business, and you can work out on a page, you know, your mortgage interest, only the interest element, your utilities, your bills, everything, and then a portion of how much time you've spent in your house. So we would say that no room is 100% business, because if it is, you're kind of into business rates and a few issues that way. But if you can apportion reliably, you know, an estimate of how many rooms is in your house and then how much one room has been for business, then you could take a portion of those costs and deduct it from your taxable profit. There are some flat rates, so you can go in and look at the HMRC, this little link here, expenses if you're self-employed. It'll show you that, you know, you can just claim a set amount per week for working from home, or a set amount per week for business costs. And that is a useful thing, but unless, in most cases, it's more beneficial to spend the time working out the actual cost, because the flat rates are very low. But it would honestly depend on the level of your records and whether or not you feel it would be benefit to work out the actual cost. So the next thing I'm going to talk about quickly is the capital allowances. So this is where I was saying, if you have an asset, even though it's not in your profit and loss, it's still useful. So this is how HMRC reward you or reduce your tax when you invest in your own business. So if you buy a piece of machinery, I'm going to say machinery, most people are probably buying computers. If you buy a piece of machinery or a computer, you don't get a deduction for that in your taxable profit, because it's an asset and it doesn't show in there, it goes to your balance sheet. If that's the case, then HMRC will give you what's called a capital allowance. And that's where you work out the value of the equipment, and then you can claim a certain amount from your tax each year as you depreciate it. So then those assets get depreciation as their life unwinds, and at the same time on your tax return you would get relief. There's actually a relief called the annual investment allowance, and it means that anything that's related to your business, so plant or machinery that you buy for your business that's 100% related to the business, can qualify for 100% deduction in that tax year. So it's most likely that if you bought a piece of equipment or a computer in a year, you would get that deducted from your taxable profits. And it's quite step through on your tax return if you're doing it yourself. And there is a HMRC calculator if you're not sure. But again, if you have a sizable amount of assets and it is confusing and you're not sure, just seek advice. You know, even if you're not sure you want to have advice all of the time, maybe for the first time you do something, it's always good to ask the question and make sure you're getting the reliefs you need or you expect, or that you should get, should I say. And then after that, then if you feel like you're comfortable with it, then that's also fine. So I've mentioned the annual investment allowance. There's also a first year allowance, which is if you're buying an electric car or anything that's energy efficient. You get the personal allowance, which is 12570 for the tax year, and that's an amount that you don't pay any tax on. And everyone gets a saving interest allowance. So it's 5,000, but if you're earning above the personal allowance, you won't really get the full 5,000, but everybody gets 1,000 or 500, depending on how much you're earning. The more you earn, the less interest you're allowed to get tax-free. So the dividend allowance, then it's £2,000 you can get tax-free. So everybody can get up to £2,000 of dividends, and there'll be no tax on those. And then the dividend rates will kick in after. The rates on dividends is lower than the rates on income tax, for which apply to profits and apply to employment income and apply to property income. So there is a benefit sometimes in having dividends, but most things with tax, if you are feeling like you need to be on top of your tax, it is all around tax efficiency, making sure you're being as tax efficient as possible. And it's about planning, because if you are a high income earner and you have income coming from a few different sources, then it's good to do some planning around that, looking at what it means and if there is anything that you can change before the tax. I've put in some slides about property income, and I'm happy to share these slides. Now I can send them out after the presentation if people feel like they just want to have the links. But it's just really around, a lot of people do have a rental property, maybe one, maybe a couple that they've bought, or maybe they've changed home and they've kept the original house and they're renting it out. It's pretty similar in that you treat it as a business and the expenses must be wholly and exclusively for the purposes of renting out the property. You will have to do the property pages for the self-assessment tax return, and it's really just working out the profit of your business, like we said, sales and cost. There will be tax relief on the interest of your mortgage, for example, but they've changed how that is now, and you can't just take that off now. You get that sort of like, it's called a tax reducer at the bottom. So they have changed that now, that you'll only ever get basic rate of the tax cost or of the interest cost. If you have foreign income, like I said, you'll not be able to claim. If your tax rate isn't the UK but you earn foreign income, you still need to show it on your tax return. If you've got credit from paying tax in a foreign country, you'll be able to claim that relief and say, you know, look, I earned 20,000 in the Republic of Ireland, I paid 5,000 in tax, unless the tax in the UK is more. So if they said, well, you owe us 7, we'll allow you for the 5, you'll still have to pay the UK government 2. If not, then you won't have to do anything. It will just automatically net off. If you pay more tax in the foreign country, you don't get anything back, you lose it anyway. And then that is actually the end of my presentation. So I don't have anything else to cover on the self-assessment side of things or on the finance side of things. Does anybody have any questions at all before? I'll just check here now. No problem. Well, I'll just put up so this is my details. As I said, a lot of the finance areas, and when you set up a new business, is bespoke and individual. So if anyone does have any questions that they kind of would like to run through on a one-to-one basis, you can give me drop me an email, or you can give me a call on the number. Okay.
Happy days. Just want to thank you very much, Lisa. That was really good. Got a lot of it. And then just as well, we're recording this whole workshop. So if you keep an eye on our social media channels and our website, if you want to watch it back, or you know, even sure if anyone else missed it, needs to watch it, just have a look on our website. It should go up by the end of the day. I'll just stop that recording now, actually.